those that kind of work with venture capital funds? Because not all are there for, a win-win situation. Sometimes, they see an opportunity, and then what they do is they go, oh, we need this amount, and they dilute them. And before they know it, they've got like maybe 1% of the company that they founded, created and everything. How does a person protect themselves with companies that are out to actually just rip them off when they see a golden opportunity?
You know what? It's hard because the biggest lie that founders tell themselves is I prefer to own less of nothing versus something that's worth it. So I could own 100% of nothing or 1% of something. I think that's the biggest lie that founders tell themselves, thinking, oh, if I get diluted, it's that 1%. At the end of the day, it's 1%. And part of it is they have to, what I have always told founders is not every company needs venture capital money. Like if you can build a profitable business by yourself, build a profitable business, build a cash flow business. But if you want to scale that business, and this is where things go wrong, is people raise a lot of money when they're not ready to scale yet. They don't have product marketing fit. They don't have a product. So they burn through a lot of the money in building things and that people no one's buying. Our view of it, because we have been founders, and especially it's a lot more in when you look at the fintech and when you look at sort of the digital token side, because a lot of people, what we saw in the past, were building products that were never regulated, that never got past the regulators, that can never go through risk compliance at a bank. And for us, we tell them, like, one, as a founder, have the domain expertise and start lining up the first couple of customers. When you're there and you have that first amount of revenue, then start looking at raising money. But, if you're raising money, so we looked at a company that I love the company, I love the founders. They raised a lot of money. The majority of that money was going to customer acquisition costs. And I was like, you're literally paying Facebook and Instagram and TikTok for users and not for the building the value of the company. You're going to end up raising more money. And now guess what? Founders get more and more and more diluted versus if they had built a profitable business, took less cash. Because one of the things that we also like, I have conversations with founders that when they get to scale, I look at them and said, you don't always have to sell equity. You could also look at credit. You could also look at other alternatives to not sell more equity, because the farther you go, the more the cash gets more and more expensive.